So welcome back. We are discussing problems on marginal costing, and I will continue from 26th question today. So refer to this 26th question. It's question number 26. He says, from the following data, ascertain break-even point. So BEP is what he's asking. Selling price per unit is given. I will say smallest is given, that is 10 rupees per unit. Trade discount. Now you might have studied about discounts in your first semester, where discounts are of two types, where we have cash discount and trade discount. So when we are talking about trade discount, it is a discount which is given by the wholesaler to the retailer. Or how do we account it? When you look at the accounting part of trade discount, we say we should not include it, we have to exclude it. So he says, I'm giving a trade discount of 5%. That means my selling price is 10 rupees minus 5% of this 10. So I can say it is 9 rupees 50 paise only. I am not reading selling price per unit as 10 rupees per unit. I am reading selling price per unit as 9 rupees 50 paise only, because trade discount of 5% of 10 rupees, that is 50 paise. Then we have direct material cost per unit, direct labor cost per unit. Guys, I have told you in the earlier classes also, whenever they say direct cost is nothing but variable cost. So for us, the variable cost per unit is, the direct material is 3 rupees. Direct material plus there is a direct labor cost. So direct labor, fixed overheads is a different part. Again, under fixed overheads you have variable overheads, 100% of direct labor. So plus we have variable overheads. So when you look at this variable cost per unit, direct material comprises of 3 rupees per unit, direct labor is 2 rupees per unit, variable overheads is equal to 100% of direct labor. So this is 100% of 2 rupees, because direct labor is 2. 100% of 2 is again 2 rupees. So it is 3 plus 2 plus 2. So it is 7 rupees per unit is the variable cost per unit. Then he has given fixed overheads, the capital F, because it is in total 10,000 rupees fixed overheads or fixed cost. If the sales are 10% and 15% above the break-even volume, determine the net profit. So the first question he is asking you to tell what is break-even point. This is the first question. The second question he is asking is, if sales are 10% and 15% above break-even, 10% above break-even point, profit is equal to how much? Is he asking you the profit? Yes. The third question he is asking you is, same thing, if sales are 15% above break-even point, above BEP, profit is equal to how much? So if you can see, is asking you BEP, sales. If sales are 10% above break-even point, what is the profit? If sales are above 15% of BEP, what is the profit? Now let us first find out the break-even point. We all know we can find out break-even point in terms of rupees or units. Which one is more applicable here? What are you going to find out here? The break-even point in rupees or in units? Which one you try to find out here? To apply units formula. Sir, why are we going to apply units formula? The answer is because he gave us selling price per unit, variable cost per unit. So per units are given. What is the formula? Fixed cost by contribution per unit. So what is fixed cost? So fixed cost is 10,000. Alright, 10,000 rupees divided by contribution per unit. You know what is contribution per unit? Contribution per unit is selling price minus variable cost. Selling price is 9.5. Variable cost is 7. So 9.5 minus 7, it is 2.5. So contribution per unit is 2.5. Get back here, say 2.50. So 10,000 divided by 2.50 gives you the first answer. How much it should be? 4,000 units. 4,000 units is the break-even point in terms of units. Now, moving on to the second question. This is the first question we asked, we got it. The second question is asking is, if sales are 10% above the break-even point, what would be the profit? So I'll try to do this one part because it is again the same thing. Instead of 10%, you put 15% and solve it, guys. So I'm trying to solve the second point here. If sales are 10% above the break-even point, so if sales units are 10% above break-even point, what is break-even point units we got? 4,000. So it is 4,000 plus 10%. 10% of 4,000. 10% of 4,000 is 400. So 4,400 is the units. If you sell, if sales units is 4,400 units, profit is equal to how much? Now you can apply any method in solving this. You can apply the marginal costing equation. You can apply the PV ratio formula. It's your wish. I'll try to apply the sales units formula. If you remember, guys, it is not necessary for you to solve it only in this method. Okay, because if you remember the sales units formula which I gave you, sales units is equal to fixed cost plus desired profit by contribution per unit. You can apply this formula in order to find out the profit. So I know fixed cost, yes sir. It will remain same, yes. Do you know sales units? Yes sir. Do you know contribution per unit? Yes sir. So can't we apply it? So I can see 4,400 units is equal to fixed cost is 10,000 plus profit is a question mark divided by contribution per unit is 0.5. Cross multiplication gives 10,000 plus profit is equal to 4,400 into 2.5. So this 10,000 going the other side becomes minus 10,000. Yes. So the plus 10,000 going the other side becomes minus 10,000. And when you multiply 4,400 with 2.5, you'll get 4,400 to 2.5. 2.5 into 4 times is 1,000, 10,000. So it will be 11,000. This is, and this plus 10,000 going that side becomes minus 10. Therefore, profit will be 1,000. This is okay. That's the second part of the question. I am not solving the third part of the question because third part says if sales are 15% above break-even point, simple. You take the same thing. You have to do the same thing once again. Instead of taking 10% here, you are going to put 15%. So if you put 15% here, you get 600 units extra. So 4,600 you will write here. 4,600 into 2.5, you get something. From that you deduct 10,000, you get your profit. That is about your question number 26. Are we done with it? Any questions you have? So I'll try to proceed with the next question. Look at your question number 27. Question number 27, if you see, the following data are available from the records of a company. Sales is given as 1 lakh. S, capital S is 1 lakh because it is total sales. Variable cost is given as 60,000. Fixed cost is given as 20,000. A very straight question. You have S, you have F, you have V. Everything is there. You're required to calculate the PV ratio, break-even point, and margin of safety. I think the first part is very simple, guys. You can straight away do it. Also study the impact of change in the following variables on PV ratio, break-even point, and margin of safety. Now, the second part is something we are going to learn for the first time in this particular chapter, because there is a change in the selling price. So I will try to explain you the concept, but before that we can basically solve what is asked in the first part of the question, that is PV ratio. Guys, what is PV ratio? PV ratio is equal to contribution by sales into 100. What is contribution? S minus V. Sales is 1 lakh, variable cost is 60. 1 lakh minus 60, that is 40,000. So come back. My contribution is 40,000. My sales is 1 lakh into 100 is 40%. What is this? PV ratio is 40%. That's my first question. First part of the first question. Then he is asking break-even point. So let's say this as A1, A2. So break-even point. Now the question comes, sir, should I apply the units formula or the rupees formula? I have been telling you, if you have contribution per unit information, go for units formula. If you don't have contributions per unit, you have the total contribution. So it is good you go for break-even point in terms of value. So what is the value formula? Break-even point in terms of value. It is fixed cost by PV ratio. Now look at this, fixed cost by PV ratio. Fixed cost is how much? Sir, fixed cost is 20,000. Okay. PV ratio is how much? So PV ratio is 40%. All right. So what should be your answer? 20,000 divided by 40%. That gives us, I will give you around 50,000. Now, yeah, 50,000 is the break-even point in terms of rupees. Then we have another question called margin of safety. So margin of safety also is not mentioned whether it is rupees or percentage. It is obvious. We'll first find out the rupees only, MOS rupees. You have two formulas here to find out. One is total sales minus break-even sales. I think we can apply that. It is sales minus break-even sales. My total sales is how much? My total sales is 1 lakh. 1 lakh. Break-even sales is how much? My break-even sales is 50,000. Therefore, so my margin of safety will be 1 lakh minus 50,000. That is another 50,000 rupees. That is another 50,000 rupees. Is it okay? So this is nothing new in this point. There's nothing new in this point. All right. Now, going further, he says, also study the impact of change in the following variables on this PV ratio, break-even point, and MOS. So what are the two changes he's asking? The second part of the question is saying that if the selling price is increased by 10%, so if selling price increases by 10% and another one, fixed cost decreases by what is the amount? Fixed cost decreases by, what is it called, 5,000. These are the two changes he's asking you to take into consideration and then solve it. Okay, can you tell me if the selling price increases by 10%, what is the new selling price? First question is, sir, we cannot say this. Why? Because I don't know the old selling price. Right? So guys, I want your attention here. Do you know the old selling price, the existing selling price? No, I only know the total sales is 1 lakh rupees. Do you know the quantity? No, I don't know. Therefore, it is not easy to find out the selling price per unit. So, How do we find it? Here the question comes is, when you say 10%, whenever we say 10%, we are talking about 10 for every 100. So we will take an assumption that if the selling price was 100, now the selling price will be 10% more than 100. So if you go back to the previous thing, if you go back to the existing situation, selling price, if existing selling price is 100 rupees per unit, if existing selling price is 100 rupees per unit, then the new selling price will be 100 plus 10% of 100, correct? So it will be 110. So the new selling price is 110. Now the question comes is, sir, is it necessary for us to do even this calculation? Guys, I want to ask you a question. From last year, my sales increased this year. If I tell you this statement, last year my sales was 1 lakh and this year my sales has become 1,10,000. What would be the two reasons why your sales has increased? Any answers from you? Last year my sales was 1 lakh. This year my sales increased by 10%. So 1,10,000. There are two reasons why your sales will go up. One is when you sell the same quantity at a more price. One reason is you are selling the same quantity. So number of units sold in the last year is equal to the number of units sold in the current year. But still the sales value goes up. Why? Because I might have increased the selling price. Second reason why your sales will go up is I have not increased the selling price. The selling price last year and this year was same, but this year I have sold more number of units. So you have to always take two things into consideration. One is the price factor, the other one is quantity factor. I'm making it very clear, guys, because this is very important for you to understand. There are two reasons why your sales could increase. It could be because of the price factor or it could be because of the quantity factor. In this question, it is very clearly said that if the smallest means selling price per unit, if the selling price per unit increases by 10%, so it's very, very clear that they are saying that the price is going up. When the price goes up, I'm talking about price factor or quantity factor. Why the sales is increased in this year? Because the price has gone up. So we assume that there is no change in the quantity. Only the price is impacted. So this is the same situation I'm taking. I'm only changing the price. Now the question is, can I take the same PV ratio? What was the PV ratio earlier we got? 40%. Do you still have the same PV ratio now also is the question. The answer is no. The answer is no. Why? You cannot have the same PV ratio. You know what is the analysis of this 40%? When my selling price is 100, my variable cost is 60, my contribution per unit is 40. How, sir? Because I am taking selling price as 100. If selling price is 100, cut two zeros, what will be the quantity here? 1000 units. Divide by 1000 units, you'll get 60. Divide by 1000 units, you'll get 40. So 100, 60, 40. 40 by 100 into 100 gives you 40%. So the present selling price is 100. The present variable cost is 60. The present contribution is 40. If the selling price increases, we have to assume that only the selling price has increased and there is no change in the variable cost per unit. So according to this, the new PV ratio will be new contribution per unit by new selling price into 100. Now guys, I want you to think and tell me, What is contribution per unit? The contribution per unit, how do I find out? What is the new selling price? 110 minus what is the variable cost per unit? It was 60 and it is still 60. It was 60,000, 60 rupees. 1 lakh if it is 100,000 units, divided by 1000 you get 60. So I'm taking same 60. So for me, the contribution per unit is 50 rupees per unit. Previously the contribution was how much? The contribution per unit is 40. Now the contribution is 50. So there is some change. Okay. Now the new PV ratio will be new contribution per unit by new selling price. So when you see this, you can go back to the question what he asked. He's asking you to find out the impact of, find out the impact of these changes on the PV ratio, BEP and MOS. Try to spend your time in understanding this. There was a change in the price of the selling price per unit. There is a change in the selling price per unit and there is no change in the variable cost per unit. So selling price increased and variable cost remains same. Therefore, the contribution increases. Therefore, PV ratio will change. So what will be the answer? If you calculate, it is 50 upon 110 percentage. This will be 45.45%. Okay, what was the previous PV ratio? 40%. What happened to the present PV ratio? 45.4545%. Now you tell me the PV ratio whether it is increased or decreased. What happens to the PV ratio? PV ratio has increased. This is the impact. This is what he is asking you. What happens to the PV ratio? The PV ratio has increased from 40% to 45.45. Now, what about break-even point? I think this is the D-May, the first part. Second part is the new break-even point. So the new break-even point will be fixed cost by PV ratio. Instead of taking the old PV ratio, you will take the new PV ratio. So fixed cost remains constant. It is still 20,000 divided by new PV ratio. Instead of 40%, I'm going to use 45.4545. Always take 4 digits after decimal so that your calculator gives you the closest answer. So 20,000 divided by, let me do the calculation for you. It is 20,000 divided by 45.454545%. It is coming to 44,000 rupees. Guys, this answer is coming to 44,000 rupees. Now you have to tell me what happened to the break-even point. Break-even point was how much? 50. What happened to break-even point? 44,000. So it has decreased. What happened to break-even point? It has decreased. Now one more, he's asking MOS. What happens to MOS? What is the MOS formula? The new MOS. It is sales minus break-even sales. My new sales. Guys, what is the new sales? 10% increase. So it will be 1,10,000 rupees minus my new break-even is 44,000. That comes to 1,10,000 minus 44,000 gives you how much? It gives you 66,000. Now look at this. Previously it was 50,000. Now it is 66,000. What happened to MOS? Margin of safety has increased. Now your comment for this problem would be when there is a change in the selling price. The first and the foremost important point what I want you to remember is when there is change in the selling price, it is going to affect the PV ratio. It is going to affect the PV ratio. When there is a change in the selling price, the PV ratio has changed and therefore the BEP and MOS also changed. Now, because there is an increase in the selling price, PV ratio increased, break-even point decreased, and safety has increased. So, what the management has to do with all these things? Now, management says If I am increasing my sales by say 10%, I am actually increasing the contribution percentage. From 40 it has become 45.45. I am able to reduce the break-even point. You know what break-even point is? Break-even point is a point where there is no profit, no loss. So you are trying to reach the break-even point only when you sell 50,000 rupees. But now because the increased sales, you are achieving that point by just 44,000 sales. So my break-even point comes down. Therefore, you are more in the safety zone. Therefore, you are more in the safety zone. Therefore, my margin of safety has increased from 50,000 to 66,000. Is it okay? The question becomes, sir, from where did you get 1,10,000? 1,10,000, you have to remember my old sales was 1 lakh and the new sales, because there is an increase in the selling price by 10%, my sales will go up by 10% in total also. So what is the important point you should understand from this particular numerical is, whenever there is a change in the price, it is going to affect your PV ratio. Because PV ratio is going to be affected, your break-even point will be affected, margin of safety will be affected, other things get affected. So whenever there is change in the price, if the sales increase, there are two reasons. One, because of the price factor, other one, the quantity factor. If there is increase or decrease because of the quantity factor, you need not worry about it. But when there is a change in the price, if there is a change because of the price factor, be careful, your ratios are going to change. This is very important, you should understand this. Okay guys, that is question number 26. We can continue with 27. Let me see. No, this itself was 27. 28 is also talking about some change. All right, I will stop it here today. Thank you all.